Hello and welcome to Livewire Markets C-Suite reporting coverage. My name is Anna Dadich. Today I'm speaking to Vandita Pant, CFO of BHP Group. She's going to be talking about the company's latest results. Vandita, great to talk to you.
Very good to be here.
So what were the key numbers investors need to be aware of from the latest results?
Well, I'll give you maybe two or three of those. One, the dividend for 60 US cents per share, that is 90 cents on Australian dollars per share for the final dividend, which is 60% payout. Second, 45% of our EBITDA last year came from copper, which is fantastic. And third, we continue to be the lowest cost producer of iron ore in the world for the 6th year in a row, with C1 cost of only $17.56 per tonne.
Shareholders will receive a final dividend of US 60 cents per share, bringing the full year payout to US $1.10, which is the lowest in 8 years. How do you balance investor expectations for returns with the reality of lower earnings?
So every 6 months, Anna, we sit down with our capital allocation framework and look at allocating shareholders. Firstly, minimum 50% payout, which goes directly any excess cash between growth, value-adding growth and additional shareholder returns. As you said, for our final dividend for this year, we have announced 60% dividend payout ratio. So every 6 months, 50% is minimum, but there is opportunity to have higher, as we did this time, off the back of strong performance, very strong balance sheet and confidence in outlook.
At 60%, the payout ratio is close to last year's, but well below the near 90% peak of 2021. Should investors think of the 55 to 60% range as the new normal, or could BHP lift payout ratios again in stronger commodity price environments?
The answer is yes, absolutely. As we have done this time, every 6 months, taking the decision based on performance, based on outlook, as well as value-adding growth. As you mentioned, we do have very exciting growth opportunities in short-term as well as long-term. In iron ore, where we are increasing from last year's 290 million tonnes to going up to 305 million tonnes by 28 onwards. In copper, across in South Australia, where we are producing around 300 KT of copper, we're looking to double that by the middle of next decade. And in Chile, where we operate one of the largest copper mines in the world, we are also investing for growth. So between now and next 10 years, BHP's growth rate will be around 2.2% CAGR per annum basis. So really exciting growth and balancing that with attractive shareholder returns. That's what comes out of strong, stable, consistent performance that we have had. BHP has had more than 50% of margin for last 20 years. And that stability is really the hallmark of BHP.
BHP's debt target has been relaxed to US $10 to $20 billion, up from the previous US $5 to $15 billion range. What's behind that decision, and how should investors interpret the increased willingness to carry debt?
Yes, we do review our net debt target range regularly. Last time we did it was 3 years back. And in last 3 years, BHP has become an even stronger and more resilient business because of performance and the portfolio choices that we have done. Iron ore, as I mentioned, continues to be the lowest cost producer 6 years in a row now. Copper, we have increased share of copper in EBITDA from 20% to 45% now. Some very exciting and more mature growth options already in the portfolio. For copper, we are closer to Jansen in terms of production and stable operations for last 3 years going on in South Australia, Copper SA as well. Given all of that, the capacity for debt servicing has increased for BHP, which leads us to change of net debt. I should emphasize that even at the high end of the net debt, our balance sheet remains very strong and leverage very conservative.
On the production side, BHP's FY26 guidance remains unchanged across iron ore, coal and copper. Where do you see the biggest opportunities or challenges in hitting those targets given current market conditions?
Sure. For FY6 guidance, you would see that we continue to have leaning into our operational excellence guidance for cost being positive, as well as higher production out of WAIO, which is Western Australia iron ore business of ours, as well as in copper. If I were to take a step back, the challenges include continuing to have inflation in many different jurisdictions, but our cost discipline and operational excellence gives us confidence, both in terms of production outcomes as well as cost outcomes. For last year, for example, across our major assets, cost was down, unit cost was down 4.7%, despite an inflation of around 3%. That continues to be the case. If the commodity markets are volatile, we have a huge margin buffer for across our assets, being the low-cost producer. For example, in iron ore, our cost of $17.56 per ton versus the kind of $100 of iron ore price today. So our teams will be really focused on making sure we focus on operational excellence and the cost disciplines as well.
Finally, if you look back at FY25, what do you think BHP could have done better, either operationally or financially, and what changes are you making to strengthen performance in FY26?
In BHP, we are a continuous improvement company, so we always have opportunities to continue to improve our own performance. We have a project in Canada, Jansen project, where we have given revised cost and schedule for the project. We're taking learnings from that and applying it across our portfolio of projects. This is really important as well because we have a lot of growth ahead of us. In copper, as I mentioned, we will be looking at growth projects in South Australia, in Chile, also in our joint venture in Argentina and Vicuña, and a joint venture in the US, Resolution. Similarly for iron ore, where we have announced an approval of a new investment of almost $1 billion today for car dumper 6, which will bring in, which will take us to the increased production, which we have guided already for 305 million tons. So overall, I would think that anything that we can learn, we continue to improve and replicate across the portfolio.
Thanks, Vandita, for joining us today.
Thanks a lot.
If you enjoyed that interview, give it a like and stay tuned for more reporting season coverage.